Welcome to the Equitymaster Mint Investor Hour, Ajit. Thank you for doing this. We launched the podcast just a few weeks ago, and it's been an honor to have all the guests that we've had, and and we understand the risk you're taking of doing this show very early in the cycle, but it's going to be fun and it's going to be light, and I promise I'm not going to be asking for a stock tip or a recommendation per se. In fact, uh, a little different from the initial podcast that we've done, one of the things I'm going to focus on today is asset allocation. I think something that a lot of people don't spend a lot of time on, and but I believe, and I've learned a lot of that from you, that in the long term, the asset allocation makes a more than significant impact on overall returns and the wealth a person accumulates. So just to give you a little bit of a heads up on that. Uh, we are, however, going to start right at the beginning. So I want you to tell us a little bit about yourself. Starting, you were of course born and brought up in Bombay. You did your schooling in Bombay. I know you went to college at Jai Hind, and you studied economics at Jai Hind.
I studied economics.
You studied economics at Jai Hind, and then you took off for the US to do your MBA. Along this whole journey, is there any pattern that Ajit would end up managing money and becoming a fund manager along the way?
So I just actually a few days ago, I put on my school chat group a little note about me in my school alumni magazine. And, when a school alumni magazine writes about you, little like 8 lines, 10 lines, little paragraph. It started by saying Ajit Dayal, who was an avid bunker at school, and then it says has set up Equitymaster, personal FM, quantum mutual fund, helper NGO, NSP, etc., etc. But it started with that description because I was not a good student. I wasn't really particularly interested in studying. So the reason I mentioned that is because I used to sit at home to play cards.
Wow. Okay.
I used to gamble but only with family, with cousins and aunts and uncles and all that stuff. Never with outsiders.
1 rupee a point or something like that, huh?
Oh, paise, not even rupees, paise. But you kind of sharpen your skills of understanding money in some sense. You're dealing with money. You're looking at people's expression, what today they call behavioral finance in some sense, right? So you're getting a sense of all of that at that young age. And my father was a doctor and he was a GP and a very well-respected and well-known GP. And I had no desire. I was not inclined to be I hated the sight of blood. So there was no way that I was going to be a doctor. And I certainly saw him work crazily hard, long hours. In those days, you got a call at 2 a.m. from a patient. You went to see the patient, stuff like that. So I saw him, waking up at 2 a.m, going to see patients, coming back at 4, sleeping, getting up again to go and see patients again in the morning. So I said, there's no way I'm going to work that hard. I'm not even that smart or intelligent. So I always believe there are 2 things required to be a good doctor. One is bad handwriting, which I have. And the second is to be smart enough to, study medicine and work hard, which I wasn't. So my father was actually a very good bridge player. He represented India in 3 bridge Olympics, but he also was very fond of horse racing. And he taught me how to read the form book when I was 12 years old onwards. I would sit with him and he'd show me the track record of horses and all that stuff. And, so did I ever expect to manage money per se? Not really, but I was always introduced to money at a very young age, right? Whether you played cards at 5 paise and 10 paise, or, flush teen pati, or whether you saw, a form book of horses. And then, not surprisingly, in the 1970s, when India, under the FARA rules, forced multinationals to sell their equity stake at a formula price at very low prices, unlike today's IPOs, to local investors. So I did participate in some of that. And then when we had the demonetization of the bills under the Janata Party, I also participated in that, in the sense that I went to Zaveri Bazaar and I bought bills for 330 rupees, 1,000 rupee note, and I went to Syndicate Bank and deposited it, and I made a nice spread. Wow. So, you kind of did all of that. There was also the time of the Hunt brothers. They had cornered the silver market. In the US, unknown to them, India had a lot of silver and there was an export ban. And then the government of India removed the export ban. And suddenly a lot of deliveries from India landed up, at the shores of Texas, where the Hunt brothers were based, effectively, giving them, they were buying futures contracts. And suddenly they got delivery and had to pay cash and the price of silver collapsed, et cetera, after a big spike. Gold that time in 79 in tandem with silver, hit a peak at that time, $800 an ounce. So yes, I was exposed to money. I was exposed to finance, but in a rudimentary street smart sense, not in the academics world. And I had an interest in English. I wanted to write. I was a writer. I loved writing and I used to write a lot of poetry. So I wanted to study English literature when I was in JN College. And they said, like, what do you do when you study, when you graduate? What kind of job are you going to get? How much money are you going to earn? So then one of my aunts, thank God, I'm in fact going to see her later tonight for dinner. She said, what about economics? I had no idea what economics was, but I went to, BA in economics in JN, and I just absolutely loved it. And that was the only time I seriously studied. And then, of course, as you indicated, I went to the US for my MBA. And when I went for my MBA, the day I arrived in America, I was sure that I would go back to India. The day I left India to go to America was the day I was sure I would never come back to India. So when my parents came to see me off at the airport, as was traditional in those days, my mother came actually, not my father. They were all crying and I was laughing like, I'm going to go and have a great life in America. Why are you all crying? And I was laughing away. And I reached America and I started crying and I wanted to get back to India. So, and of course then I studied finance and, mutual funds were very early stage in 1982, 81, 82, 83, when I was in America. It was an innovation of Merrill Lynch, where they allowed you to have, for example, what we call the liquid fund in India. Imagine if you could write a check around your liquid fund money. So that's what Merrill Lynch did in America. As the regulations in America changed, you've all heard of the Glass-Steagall Act. So as the regulatory environment changed, you had changes there, and Merrill Lynch came out with this product. And that's when mutual funds took off in the early 80s. That's also when stock markets took up after a 15, 20 year, kind of dead sideways movement in the US. So yeah, so that's when I started getting interested in money, and I wrote, I'm actually carrying it with me. I can show it to you all. Yeah, sure. I'm actually carrying with me, strangely enough, I wanted to frame it. So this is my first note that I wrote while I was studying in America about creating a mutual fund in India. Oh, and wow. At the back, I have written, there's a blocks of things out there. And I wrote this to my cousin who's a lawyer. And I had no idea what NRI really was and all that stuff. I just knew about Indians living outside India having a lot of money, and India was a capital-starved country. So again, that was all from my economics, right? Because in economics, you understand savings, gross domestic savings, you understand capital formation, capital investment, and from that comes GDP. So a lot of my landing up as a portfolio manager or Equitymaster, personal FM, quantum mutual fund really came from this background of playing playing cards at home, doing stuff around silver, doing stuff around horses, and then the study of economics around it, and then the MBA. So for someone who's come with that background, I've taken a lot of risks. When you play cards, you take risks. You back horses, you take risks. And having learned all that, I've kind of understood and tried to define, as you spoke, about asset allocation, to recognize this strong relationship between risk and return, and why every investor must understand that and then build their portfolio in a very conscious, knowing way. Sorry, I gave you a long answer, but I kind of went around the world to come to this. Perfect.
It's perfect. So before we proceed, I must mention this on the podcast that your father, God bless his soul, I went to him so many times when I came to Bombay. I was, of course, working at Quantum, and I would just hop over and meet him. And it was a lesson. You, of course, got treated, by a very seasoned doc. But it was a life experience, and God bless his soul again. So coming back to your the journey you described, I know there's something that happened at Keenan Flagger Business School. That's where you went.
Yeah, UNC
Uh,
Keenan Flagger.
and you ended up also taking a course. Was it business ethics?
Ethics in business, correct.
Ethics in business. I think that had a big impact on you.
Yes, yeah. So I told you when I reached America, I wanted to kind of head back. And so, while I was doing the MBA, I mean, I would wake up in the night with a sweat because I learned the concept of net present value and, discounted cash flows. So here I am, thinking I'm going to go back to India, get a job with Citibank or Hindustan Lever and get paid 1,500 rupees a month as salary. Those were the salaries in those days every month. And, working out that I was paying $8,000 a year in those days for an MBA. It was about 8 rupees a dollar. So you do the math on it. You're spending $8,000 a year at 8 rupees a dollar, and you're earning 1,500 rupees a month. You're spending 2 years of money, right, at the education. Your net present value is negative. Like there's no way you can ever recover the cost of education. So, so I'd wake up with a sweat and say, how am I ever going to repay my father? Or not that it was a debt, but an obligation that he did something for me and I must look after him in his old age and all that stuff. And at some point in time, I said, okay, fine. I will continue to live in the US, but I'll work with the World Bank and I'll go and work with the IMF and I'll, help India develop through the World Bank and IMF. So it was Professor Jack Behrman, who was my professor in ethics and business. And another course that he taught was international marketing. So he worked under John Kennedy in his cabinet when John Kennedy was president, JFK. And he loved India. He used to sit in his room, small little cabin that professors have in the US, and air conditioning off, and he'd sit with his eyes closed, and he was meditating in that sense. Now, 1981 to find someone meditating in the US was it was very unusual. Today it's fashionable, it's common, yoga is a big thing, etc., etc. But it was very unusual then, and Professor Behrman encouraged me to the idea of doing things for India as opposed to getting a job in the US. He encouraged me that. And when I finished the MBA, I had a chat with him about, what I was going to do next. And I said, what about a PhD, or what if I go and work for the World Bank and IMF? Because to work for the World Bank, IMF, you generally need the PhD. And because of my BA in economics, I could have done something with him in, kind of economics finance. So he said, look, I have a friend at the World Bank and IMF, and I can send you to meet them for an interview. So I actually went by bus from North Carolina, took a Greyhound bus and went there. And when I reached, I went there for the interview, I came back, buses took 8 hours or 10 hours or whatever to go up and down. So by the time I came back, Professor Behrman told me that his friends had called him and said, smart guy, nice guy, we'll hire him. But he said, why do you want to work for the World Bank and IMF? I said, oh, to help India. He said, no, they don't help anyone. They write a lot of reports and do useless stuff. So if you really want to help India, go back to India. So, my father obviously was not very keen that I come back. He was a doctor. What will I do with an MBA, et cetera, et cetera. So he arranged for me to have an interview in New York. An international Sindhi family was in India, and they fell ill and they went to see him. And they were just happy to tell my father that they were opening an office in New York in July of 1983. That's when I graduated. And my father said, oh, I have a son there who wants to come back to India, and tried to convince him not to come. And they said, no, we'll talk to him. So of course, in the month of July, I interviewed with them and they said, you must work with us. So I got a job in New York and I stayed there for a little less than a year. And then I finally decided to come back, and I came back. But to get to your point, it was Professor Jack Behrman, who was a big influence on continuing to keep that India focus, but saying that to change India or help India, you have to go back and do it in India, not World Bank and not IMF. With all due respect to World Bank and IMF and IFC and everyone else.
So then, of course, you came back to India, and somewhere along the way, you met a gentleman called Ashok Birla. Now, you've written about Ashok Birla in the past, but I'd like you to share maybe how that interaction happened, and what it taught you, and what were the outcomes of that, really, that relationship that you had with him.
Yeah. So I met Mr. Birla. So the first thing you do when you come back in July 84, when I landed back in India, is you can't go to a dentist because it's too expensive to have dentist work done anywhere else in the world. and went to a dentist, and you have to always wait. So they always have old magazines to
Mhm.
read, and there was an old Business India magazine lying in the racks. I picked it up to read, and the cover story was mutual funds in India, and it was dated, I don't know, April or May of
Mhm.
1984. It was a few months old, obviously. They keep old magazines, etc. And so I picked up that magazine, and I read because remember, what I told you that I wrote,
Mhm.
which
Mhm.
really was a blueprint for a
Yeah.
mutual
Mhm.
fund in India,
Mhm.
effectively. So I was intrigued, and there was Unit Trust of India. That was the only mutual fund of India. It was on Government of India monopoly at that point in time. Mutual funds were not allowed.
Mhm.
And in that, I read about this strange man called Mr. Ashok Birla, who had this strange idea about raising a private sector mutual fund from international investors and NRIs to invest in Indian stock markets. And that's exactly what this was about.
Mhm.
And I said, this is fantastic. So I did not know Mr. Ashok Advani of Business India. I called him up, and I told him I'm Dr. Dayal's son, because he kind of knew my father, or knew of my father, I imagine, which he did. And I said, could you help me? I've come from the US. I read this article. Can I come and see you? He said, sure. I met to meet him in his chambers at the Bombay High Court. And I told him exactly what I had in mind, that I wanted to meet the people he profiled in that article: Hemanta Kothari, Bhupen Dalal of CIFCO, Hemanta Kothari of DSP, Bhupen Dalal of CIFCO, and Mr. Ashok Birla. So he was nice enough, and he made the phone calls right in front of me to each of these three gentlemen. And he said, I've got this, young man next to me, and he wants to talk to you all. And they all gave me a time to meet them. I met Mr. Hemendra Kothari. He was very smart. He said, you're smart, you're young, but you know nothing. You go and work somewhere else and come back to me after a few years.
Mhm.
Mr. Bhupen Dalal of CIFCO,
Mhm.
he said he started talking to me about, a job. And
Mhm.
then I met Mr. Ashok Birla. And, I did not know much about the Birla family at all. I really hadn't read much about them, besides whatever little we knew about their stocks, said Century and whatever in the market in those days. So I went for an interview uh, with a pinstripe suit and everything, very American. And I'm sitting on the top floor of Industry House, which is their headquarters in Bombay.
Mhm.
And it's all like a white, it's a circular room, the waiting room. And there are gaps which are doorways to go to different parts of it. And there are all these pictures of the Birla, Mr. R.D. Birla, G.D. Birla, who were the brothers, uh, and, kind of looking very sternly at you with their pictures down and all that stuff. So uh, a gentleman came from one corner, and he went to the other, other end of the room, and he was wearing, like, shoes with no socks, uh, beige colored trousers, and like a light shirt open to the chest button,
Mhm.
with a mustache, and I kind of gave him a dirty look, like, what are you doing here? Because, I'm wearing a suit. These two Birla portrait guys have suits on, and what are you doing here without a suit? Anyway, he went there, and then he came out the other side with his hand on his zip, and he went off, to the other end of the hallway. So then afterwards, a guy in a white topi comes and tells me, Babu bula rahe hain. Babu is calling you. So I
Mhm.
go in, I push the door open, and that same guy who I gave a dirty look to is behind the desk. And that was Mr. Birla giving me the interview,
Mhm.
having the interview for me and all that stuff. It was quite amazing. And, he asked me, he says, why do you come back to India? So I said, to help India and to change India. And he said, in what way? And I said, to get rid of black money and corruption. And he said, you're hired.
Oh, wow. Mhm.
Yeah. And now, this is the Birla family who probably won a lot of licenses in a lot of strange ways,
Mhm.
and, stuff of that nature. But, my interaction with him from that interview onwards was just fantastic, because here was a guy who I later realized and experienced in the 1984 till 1990, when he sadly died in a plane crash, who had a great vision of India.
Mhm.
I mean, he had the most phenomenal mind. I had the pleasure and the honor of interacting with the late, with Rahul Bajaj and
Mhm.
Keshav Mahindra, and so many other people who no longer are alive, of the old industrial families, and some who are. And from all the people that I interacted with, I thought Mr. Ashok Birla had by far the most forward-thinking, India opening up benefit to India mind. He made me write articles for L.K. Jha, who was that time an economic advisor to the government, and to the RBI governors about setting up a dual exchange rate, right? So we had the official exchange rate and we had a black market. And he said, why is it a black market? Let the government itself sort of legalize the black market. So you have one rate for certain goods, which are important, which are like, say, if you're buying defense and arms and oil, you have one rate for that, the official rate. And if, Ajit wants to go and study in the US or take a holiday abroad, have a second rate and make that 40% higher, 30%, whatever it is, right? So that you basically capture the black market premium into the government's coffers and you become the market maker for that. So he made me write all these. Again, that was my background of economics and finance, so I could write about policy, write about thought process and all that stuff. So it was a great blend in terms of my academics. And then this man who gave me tremendous freedom and tremendous insights. And that's one thing that I love to give everyone at Quantum is the ability to meet all kinds of people in life and to make decisions and to just learn from my experiences, because that's how I kind of benefited, for a long time. So yeah, he was an absolute genius. And his last interview in Business India, I remember very well, he made this comment. He said that he had great ideas, but he was never successful because he didn't have great people implementing the ideas for him. I hope he wasn't referring to me at that stage in time, but anyway, but that really was a failing of his, that he didn't have great people to implement his ideas and things that he started in that way. And one other last thing, I remember in 1989, I was sitting with him in his house. I used to go quite often to meet him late in the night and just talk about different things. And, again, news was very limited. We used to get the Wall Street Journal one day late, the Financial Times one day late, CNN had just started. There was still a lot of controls on media. It was not yet a free economy. This is 1989, prior to the 1991 reforms, etc. And your big news was, Pranay Roy and NDTV did that show for Doordarshan, and that was kind of
World This Week.
The World This Week. I mean, those are the kind of things, and there were those kind of news which were, Raghav Goel did something about economics. We did something with Amit Khanna called Business Plus, where we'd have a video done every month. We started that in around that time, I think it was 1990. Anyway, so we were sitting there on the BBC radio was on, and they said the Berlin Wall had collapsed. So Mr. Birla was sitting with the glasses at the edge of the thing, reading his paper. He put his glasses up, he looked at me, and he said, "This is India's moment." And I didn't understand what he meant then. It took me years to understand what he meant. Sadly, he died a few months after that. But what he really was saying was that India had adopted the Soviet style of economic growth. And with the Berlin Wall falling, the USSR was going to collapse. Soviet Russia was collapsing, and India would finally turn west. And that's exactly what happened. Right? This is a man in 1989, October, whatever the month was, when the Berlin Wall is collapsing, and he's kind of visualizing this is India's moment. Sadly, he's not alive today to see it, but he was an absolutely brilliant man, lots of ideas, loved to sort of delegate to people, as he himself admitted, not the best selector of people that he could delegate to implement ideas, but was an absolutely brilliant man, and sadly never really converted that brilliance into great market cap success in some sense.
So at some point in time, as your association with Mr. Birla was evolving and growing, you went on to do other stuff as well, right? You wrote the comics, which became very popular, about what is the stock market, how do you pick up, and in 1990 is when you founded Quantum, if I have the year right.
Correct.
So and then of course you started on this other, so you turned entrepreneur, for lack of a better word. You became officially an entrepreneur. You set up a company and started doing stuff. Now I want to rush through the 90s because I think there's a whole bunch of things you did in the 90s. I think you had a joint venture with Jardine Fleming. This was the first FII to come to India?
Correct. From 1992 to 1995.
You
correct.
had a joint venture with Jari Fleming. Then you did a joint venture with a venture. Or you had an arrangement with a venture capital fund.
We were the local advisors for India's first, second venture capital fund. Draper and us did it the same week. We signed our agreement first. They announced it to the press first. So we did the first venture capital fund in 1996.
And they got the first press release, but
Yeah, they got the first press release. We had the first document.
Okay,
but
wonderful.
anyway, but the same week we both announced it. Yeah,
wonderful. And of course, in the 90s, you also had Equitymaster launched, which was India's first financial website.
correct.
Right. So it was a busy decade for you. Towards the end of the decade, I think you also entered into a partnership with Hansberger Global Investors.
Correct.
Founded by Thomas Hansberger.
Tom Hansberger. That was 1997. Tom Hansberger was a co-founder of Templeton, Galbraith, Hansberger. Templeton, Galbraith, Hansberger was an equity shop, and they were bought over by Franklin, which was big in fixed income and had no international equity exposure. They wanted to build an exposure to equity products. So they bought over Templeton, Galbraith, Hansberger. Sir John Templeton retired, Galbraith retired. Tom Hansberger did not retire and decided to reinvent the wheel and set up a firm under his own name, Hansberger Global Investors, in 1994. And I met Tom 3 years later, 1997. And that's when we had the partnership with Tom for 7 years and learned a lot from that partnership. We owe much of what we are today in the investment world to what we learned under Tom's guidance.
So if I was to just recap the 70s, 80s, and 90s, from someone who was playing teen patti and doing horse races, you ended the 90s as a long only value investor.
Exactly. Absolutely.
Very explainable. It makes a lot of sense.
Metamorphosis, right? You have a little larva that becomes a butterfly sort of thing. So you go through stages of life and you learn different things. But, even when I was gambling as a kid, you never, that's nothing about it, right? Even now I do stupid things, but I do stupid things with small amounts of money.
Yeah.
And my rule is for that is very simple. And I'm happy to talk about that now. We can talk about it later. But if I just expand on it now.
Yeah, let's do it. Yeah.
So if I look at my asset allocation, and I put this in the comic book in 1987. 1987, we came out with a comic book on the stock, what is a stock exchange. And then in 8-10 months later, I launched a second comic book saying how to read a balance sheet, how to financial analysis, and all in comic form. That was funny, but I took the Japanese thing called the manga, which is how do you use illustrations to take a complicated idea and try to make it into a simple explanation. And that's what I did with the two comic books. The first comic book, by the way, the stock exchange one, in those days sold about 1 lakh copies.
Wow.
And we sold them through all the paper wallas outside Bombay Stock Exchange. I used to personally go and kind of push the product.
What was it priced at those days?
5 rupees for the stock exchange.
That's quite a lot of money.
We had sponsors. We had Canara Bank as a sponsor. We had Standard Chartered as a sponsor. We also came out with the stock market yearbook in 1988, the first guide in terms of, we didn't give future estimates on companies, but profiles of companies, what they were doing, their board members and all that stuff. So that happened in 1980. So you're right. I mean, in the 80s and 90s, there's all this change going on where I was trying to create databases and have information so you make more informed decisions. And that's when that asset allocation triangle idea sort of came in. So at the base of the triangle is what we call safe money. You're looking for safety. You're looking for liquidity, money that you may need immediately, money that when you want it, it's available to you. So it must be liquid, must be, if you think it's worth 100, it's got to be worth 100. Then above that, you have your basic investments. And then in the middle of the triangle, if you break the investments up into 2 parts, you have kind of investments that you want to be a little more careful about. You're not willing to gamble them away. And then right at the tip of the triangle, the third part of the triangle, the tip is what we call play money. You want to do masti. You buy Bitcoin, you want to do a bit of satta, you play cards, you want to back horses, you do whatever you want to with that. And the way I look at play money in my life is, and that's how I measure it, and others can use their own formula, is that play money is that much money you must put aside to play cards or back horses or buy Bitcoin or whatever you want to do with it, where if it goes up 10 times in value, it will not change your lifestyle. And if you lose all of it, it will not change your lifestyle.
Okay.
Right? So if I'm playing cards and I've got a budget in those days as a thing of 10 rupees, all right, fine. For like maybe 2 weeks, I won't eat supari, right? I won't go and buy jeera goli, and I won't go and buy powder supari, and I won't go and buy Milan supari, I won't buy ice cream. So that's my cost for 2 weeks. And, if it goes up by 10 times in price, all right, I'm not going to eat more supari or more Milan or more ice cream. It's not going to change my lifestyle, per se. Right? I mean, it'll change a bit that I'm not going to enjoy my ice cream for 2 weeks, but not going to change my long-term lifestyle. So things like that. That's what I do with play money. But the base of the pyramid, and I go to this straight away, that's got to be your safety money. And we've defined it and refined it over the years as you learn, but the basis and the thesis is still the same. It hasn't changed.
Yeah. So let's stick with the allocation. Now, I think we are talking about this, so let's focus on this a little bit more. So when you say the base of the pyramid, you said it has to be liquid as well.
Yeah, safe and liquid. Yeah.
Safe and liquid. So that rules out that's like FD in a SBI or a FD in a post office, or a liquid fund which invests in only government securities where the credit risk is zero. So it's that kind of money.
It's that kind of safety, exactly. Yeah. And also recognize that an SBI FD, there may be a cost to break it. So if you think it's worth 100, if you break it, you may have a penalty, you may get 99.
Yeah.
Right? So so something which is liquid means the transaction cost of getting it back in your hand is close to zero.
Yeah.
Right. So if I have cash in my wallet and I want it in my hand, the transaction cost is zero. 100 in my wallet is 100 in my hand. 100 rupees under a mattress is 100 in my hand. 100 in an FD, which is for 3 years, is not 100 in my hand, is 99 point something. Right. So when you say liquid, so liquidity is the ability to get something back in your hand at the least, if not zero transaction cost.
Yeah. So
no friction.
I remember, I think it was a couple of years ago, 2020, you wrote a guide of, I'm not sure I remember the name. Was it 12, 28, 20?
12, 20, 80. Yeah,
12, 20, 80. 12, 20, 80. Okay.
Yeah.
So talk to us about that 12, 20, 80.
So this is around the time when I was writing the honest truth for Equitymaster. And after the Lehman crisis, I wrote an article while I was on holiday and saying I'm on holiday and enjoying a beach and sunshine or something or the other. And I actually got, I think it was 2 people who responded by email or comments saying that's very mean kind of thing. How dare you go on holiday when markets are collapsing and everything. And I said, hey, I planned my life that way. And I realized that was again come down to asset allocation. So then I again started writing at the bottom of every honest truth. I would write this sort of table of the 12, 80, 20, 12, 20, 80, whatever, however you want to call it. And what that really was, the 12 is, what are my monthly expenditures? So let's say I've got a corpus of 1 crore of rupees as savings. Let's put that number aside. And I'm spending 1 lakh a month. So 12 means 12 months of my expenditures. So 1 lakh into 12 is 12 lakhs of rupees. So I keep 12 lakhs of rupees at the base of the pyramid, which is, in my case, the quantum liquid fund. I put some money in bank accounts. I have no FDs at all, but the quantum liquid fund. And the other part of the money is 2080. So I've got 88 lakhs left, 1 crore minus 12 lakhs in the quantum liquid fund. I have 88 lakhs left. The 88 lakhs, I split up 2080. 20% of that 88 lakhs, which is roughly about 17.6, so 18 lakhs roundabout. So 18 lakhs goes into gold, in the quantum gold ETF, on the quantum gold fund, sorry. And then the balance of the money, so 88 minus 18, 70 lakhs is put into quantum equity funds. Now, because of a whole bunch of regulations and everything else, I don't buy individual stocks anymore. But a subscriber of, say, Equitymaster or a subscriber of Personal FN may create a basket case of their own funds and their own stocks, as opposed to going, directly into funds. But in my case, I put the money into quantum mutual funds, and we've got 3 products there, equity side. So we've got the quantum long-term value fund, which I learned from Hansberger and implemented that in India on the value style, which is what I strongly believe in. And then we have an ESG fund now with a nearly 3-year track record come July 2022. And then we have this quantum equity fund of funds, which is a very unique fund where we look at funds created by other fund houses. So there are 400 equity funds out there. If an investor does not want to buy direct stocks and listen to what Equitymaster has to give on advice, and they want to buy a mutual fund, how do they know which fund is out there? So Personal FN, and another company in the group which I helped create, Personal FN has this, research database of which funds are good and which you can buy into. Now, if you don't want to make that decision yourself and you want someone else to make it for you, Quantum Equity Fund of Funds is given that answer. You come to Quantum Equity Fund of Funds, you give them the money, they distribute that money to 6, 7, 8, 9 other mutual funds, and they track and select the funds. The beauty of that product, by the way, is that every time Quantum buys or sells a fund or redeems a fund, the equity fund of funds, there is no tax at the equity fund of fund level. If I, as an individual, were to redeem a fund, depending on how long I held it for, there's a tax. Right? So there, it's like when you buy a mutual fund of shares. When the fund is buying and selling Infosys or Wipro or TCS or ICICI or SBI, there's no tax at the fund level. The tax only occurs when the individual redeems from the fund, right, of that equity fund. A very similar way. Anyway, so that balance 70 rupees, I distribute into that bucket of these 3 funds. Now, because I'm a value person, I have a much larger allocation to value funds than a normal retail investor should have. That's because I'm a value guy, so I love that product, and I have some other allocation to the equity fund of funds and the ESG fund. But that 70 rupees, we again suggest in the 12, 20, 80, we again suggest to split that with a larger weight to the equity fund of funds, so it goes to other fund houses, and then little bit to the ESG fund and little bit to the value fund. So that an investor with this very simple solution has got a phenomenal basket which is working in for their benefit. If you go back in history and you come back, say, to the year 2000 or so, when we started the value fund as a track record, you make a return of roughly about 12, 13% in such a product, and 12, 13% with far lower volatility. So you don't wake up in the night with a sweat that, markets are down 50%, because generally we've seen in the time of Lehman, even now at the time of March 2020 with the pandemic, and even the last few weeks, when markets correct, gold tends to fall a lot less, if not increase. So gold acts like a nice hedge to the portfolio. And of course, when you have that safe money, it's lying in liquid funds, so it's not earning you much money, but it's a buffer. And it's there for you to use to recalibrate your life till the world stabilizes again.
Yeah. So I like, one of the reasons I like this approach is because it's very simple to actually execute and it works. Yes. For example, if someone had implemented this process earlier this year, he would not be worried about market movement because he's got 12 months of cash. He can still go on his summer holiday this month or whenever he's taking the break. Your allocation to gold, correct me if I'm wrong, when probably I first bumped into you 25 years ago, you probably mentioned that gold should be 5-10% of your portfolio.
Correct.
Now it's a larger amount. Has anything changed in what's changed in your thinking that you've increased your allocation to gold over time?
So from August 15th, 1971, that is the day when President Nixon decided to take the US dollar off the gold standard. So till August 15th, 1971, in theory, you could walk into a bank in the US and say, that time gold was about $38 an ounce, say for $40 an ounce. You could take $40 and say, give me 1 ounce of gold. Or you could say, here's an ounce of gold, give me $40, either of the two, right? Because the dollar was back to the gold. Yeah. And August 15th, Nixon took that peg away. And we've seen that the US dollar has effectively collapsed by 95% against gold. If you look at, what was 1971 price of gold, it was about $40, like we said. And today it's $1,800, even though it's come down a bit recently. And we've seen an acceleration of money printing around the world since 1997. You've had different stock market collapses that have happened, and they are wrongly called black swan events. A black swan event is meant to happen only once in a while.
Yeah.
But these happen with a routine because the field of finance, with its sort of highly questionable practices and its sort of political lobbying and connectivity with the field of regulatory environment, has basically been very lax in terms of discipline. And you've got the central banks of the world printing money, shamelessly, and basically debasing the monetary, the value of fiat currency. So that's where I think you've got the disconnect. I think you've got a situation where gold should be much, if you just look at the monetary supply base in the world, even though the Fed is now shrinking its balance sheet and raising interest rates, there is so much excess built up. 80s, 90s, 2000, every collapse, more printing, more money, rather than feeling the pain. And therefore, I believe gold is undervalued, and therefore I've upped my allocation on personal level from 5 to 10 to 10 to 15, percent of gold. I mean, for those who are even more traditional, I would not be surprised if they even have a 20% weight of gold.
That's right.
Such, right? In some sense. And I'll tell you one other thing that I've done for myself. I have ensured that my 12 months is actually 36 months for me.
Okay.
Because it's my personal situation. Everyone should look at that. So don't stick to the formula of 12, 20, 30, 80. You can make it 36, 20, 80, or whatever you want, or 36, 10, 90. But that's the starting base. And the reason I do 36 is because in my broader family, I'm probably the only breadwinner or bread earner. I have responsibilities to look after other people who are not necessarily earning, etc., etc. So if you're in a situation, you should need to tailor make that. It's not a rigid formula, right? You take the triangle and you make your own 3 compartments of what is your safety, liquid emergency money, what is your investment portfolio money, and what is your play money, right? You make your own compartments in that sense.
Yeah. So this is very helpful, and I think it serves as a guide. And what I like about it is also one more thing I like about it, apart from the simplicity, is it's you don't really have to care about the market movements, right? It's suited for you, and you can live with it for 5, 10, 15 years. And that just takes away so much day-to-day pressure of looking at the TV channel and figuring out what's happening to your wealth.
If I can just make one quick thing here to round this up before you move to another topic, is I know that on the Quantum Mutual Fund website, they now have this. You should look at it, and you can play around with it, and you can do your suggestions. You get your suggestion, and then you can, they'll give you a recommendation based on 1228, and you can play around with it to whatever you want. And literally, and there's another thing, that's there, is that we want to keep it as low cost as possible. So when you do this, your entire portfolio cost, I think, is some 0.4% of this blended product.
Oh, wow.
0.45 or 0.4, something like that. It's like very low. And they're coming up with another other option that'll be half that, very shortly.
Costs are important to manage. So a very quick comment. When you say gold, do you mean pure gold, or you're saying bullion, which includes silver?
So I would equate gold. So I would say it with pure gold. You can put some silver. I've got some silver, but it's not a lot. I prefer gold to silver because silver's price also is determined as an industrial use metal. So its price also the function of how there's economic activity. Whereas gold is probably 80% as precious metal and 20% as non-precious metal uses. Silver is half and half. So it's kind of half copper, half gold sort of thing, as it's called. So, but just trying to say other thing in the history a bit, that I also managed money for Vanguard. And I understood from Vanguard the importance of keeping costs low. That's why we were the first to launch India's first direct-to-investor mutual fund in 2006. And at the same time, when we come out with 12, 20, 80, very conscious of keeping the costs low and very predictable. As John Bogle, the founder of Vanguard, who passed away a few years ago, sadly, always used to say that costs are known, returns are unknown and unpredictable.
Yeah, that's something to think over. Okay, so one more question on allocation before we move to other stuff. A lot of people who are listening or watching right now are thinking, okay, you got cash covered, you got gold covered, you got the risky assets, equities covered. Where does property stroke real estate fit for you?
I don't think of property as an investment per se. I think of it as more use, like for your use. So I keep it out of the equation. I would say 90% of us in India are buying their first home. Maybe 95% are buying their first home. And I think till you've got your first home paid off
Mm-hmm.
and you've paid all the mortgages off and everything, I don't think of property as something which you should, as a second investment besides what you've already invested in.
Mm-hmm.
So I don't really consider that as an investment for a lot of people. Now, if there are high net worth individuals or those who've already got their first property, or you have, young children who are about to get married or have their own homes, and you want to help them with a down payment, that's a separate, allocation that you
Got
make. And you keep that aside, and then you come back to what's left after that. So I would not put property as an investment for 95% of people, in my view.
Okay.
I would
Great.
take it out of the equation.
So before I ask you even more questions related to this whole money thing and related stuff, I want to go to your Twitter account. Now, I have not checked it off late, but the last
Nor have
I
I.
saw, the last I saw, you had 4 flags out there. The UK flag,
Oh, yeah, okay.
the Swiss flag, the US flag, and I think the Indian flag. Was it 4
Of
flags?
course, the Indian flag has to be
Of course, the
there,
Indian
for
flag.
sure. Yeah.
So you had
Yeah.
4 flags.
I have 4 flags out there. Okay.
So
Why do I have 4
yeah.
flags?
So what's the story behind that?
What's the story? Long story. We have a separate podcast for that. But the bottom line is, of course, I'm Indian. I'm born in India, grew up in India, love India. Most of my life has been working, around things which are in India all my life. Focused on in India-based project solutions, whatever. I was married to a lady from Switzerland, and my children are Swiss. They were born in Switzerland, so that's the Swiss flag. Switzerland is, in that sense, my home. I fly there a lot to meet my children. They're young adults now. Can't say children, but they are still my children. And the US, because that's where I studied, lived, worked with Tom Hansberger. Went to UNC, met Jack Behrman. I love going down vacation. I still have an apartment which I kept there in the place that I used to work when I was with Tom Hansberger, a place called Fort Lauderdale. Not only one, I actually bought 2 more. Now I have 3 apartments in that same building. And I bought the other 2 bad. Now this is where investments are bad. I bought it just before the pandemic. And I bought it because I wanted to spend time with my friends. And one way to attract friends is to say, I have an apartment for you, please come and stay with me, right? And they all come lining up. It worked beautifully the first year. And then for 2 years, I was locked down. I couldn't, no one could fly to America. So there was no question of, so I just paid a lot of maintenance fees and, property taxes for that. And then UK. So I was on my way to the US for an eye surgery when they shut down the flights. So I could not leave the UK to go forward for my eye surgery to the US. Why? Because while I was living there, I was diagnosed with some eye problems. And so my doctor seen me there for 20 years, and I was meant to have the eye surgery in August of 2020. Anyway, so I could not go to the US. I could not come back to India. And I had to wait till all the vaccinations were done. So UK gave me the vaccines. They were, of course, probably made here at the Serum Institute, but I took my vaccinations in the UK. So they saved my life, I guess, for COVID. So that's why UK too. So yeah, so I've got 4 geographies that I still, and I actually am spending more time in UK. So we were doing something around ESG. So just prior to the pandemic, we were very keen as quantum advisors and quantum mutual fund to do a lot of more work on ESG, which we started in 1996. We have this governance rule in our value fund and wanted to understand more. So I actually went to London with the view, and I chose London because London is the impact capital of the world. Everything about UN sustainable goals, ESG, a sort of governance, impact investing. London is by far the thought leader of that. So I actually positioned myself, and I took a service apartment on rent for a while to make it a home for a few months, a base to travel across Europe, as opposed to US, which is quite backward on ESG. So I could use London as a base and travel to Copenhagen, travel to Sweden, etc., learn what's happening. And then the pandemic hit. So like I told you, I got stuck there and couldn't really do anything. But
Mhm.
yeah, so that's why the London flag is there, because it's, I still go there. I still have a place. So I'm now straddling 4 geographies,
Mhm.
and each of those 4 flags, I have a reason to go to each of those 4.
Yeah. You know, I
So
could,
I'm very happy that flights are back to normal or close to normal.
you know, I could add a 5th flag if that place had one. That would be Goa, right, for you?
Yes, Goa
Maybe,
I
yeah.
go to, but not that often. I would like to go there more.
Yeah.
But when I'm here, I'm mostly in Bombay. So
Mhm.
I went to Goa in December of 2021
Mhm.
for, a few days, but not
Mm.
not since then.
Okay. Okay. So I want to talk to you a little bit more about investments, right? Uh, and I'm keen to get your view for someone who's a value investor, right, and who's seen gambling in the early days. Uh, I think one of the biggest challenges that this current generation of investors has is how do you either buy into or not get swept away with these new ideas that are coming, right? Now, you've had this, now some of them are available in India, some are not. For example, you've had this massive issue with SPACs last year, right? Hundreds of billions of dollars of SPACs. In India, you've had this whole IPO craze that has happened, which I think peaked earlier this year, earlier this year, I guess. You've had this whole crypto craze that is happening. So for someone who's seen all these cycles for, I guess, what, this is your 5th decade of seeing them closely, if you will.
You're really dating me now, but yes, something like that. Yeah.
So talk to us a little bit about this. Tell us whether you got swayed by any, right? And what did you learn? Or if you did not get swayed by, what was your reality check? And how did you stay away from this? The more stories, the better in this. Yeah.
Okay. So, if you're an equity investor, which I am,
Mhm.
firstly, you have to be an optimist because you're buying into the future story.
Mhm.
So you can't be a pessimist and be an equity investor. Then you got to be short all the time. You can't be a long investor. So you have to be optimist. At the same time, you got to not be carried away, and you got to try to figure out the future. What is a likely reality and what is fiction, right? So it's never easy, and you can never get those things right on a consistent basis. But it's important to be right for a longer period of time and with more things, and to be wrong, for a shorter long. You should be wrong for a shorter period of time and for few things in some sense. So if you have your rights are better and your wrongs are fewer, that's far better, obviously. So I think the way to measure it
Mhm.
is to have that optimism, which is inherent. And
Mhm.
the other is to try to, kind of visualize that future and participate in it by trying to have certain metrics. And the metrics can be, now, the one thing we hear about today is TAM, total addressable market.
Okay. Mhm.
Now, I look at TAM, I mean, everything is a TAM for me, right? If I'm sitting in quantum mutual fund and
Mhm.
I see that there are 1.2 billion people, I can suddenly say, okay, out of 1.2 billion people, maybe there are 400 million people below the age of 21 or 18. I've got a 800 million TAM.
Mhm.
So you can create this TAM story about everything. And I say it because right now there's an IPO going on, and I saw a little subhead headline, our TAM is something 300 billion or whatever it was. So you can have the TAM number. That's fine. We all can have a TAM number. But I think the more rational way to look at these is, if you're making an investment in something which is a concept,
Mhm.
you take that play money part
Mhm.
and invest your play money in it,
Mhm.
right? So as an entrepreneur, as you sort of described me,
Mhm.
um, we did invest in technology by setting up Equitymaster as India's first, financial website on April 22nd, 1996, 20,
Right. 6 years ago. Yeah.
26 years ago and
Mhm.
change. So we did that. It was, we invested business money into it. That is not it was a concept, we put business money in it. Now, if I was to invest in pet.com or, Nika.com or whatever it is, I
Mhm.
would put play money in that
Mhm.
because I don't know who those winners are. very difficult to gauge who is going
Yeah.
to actually win, right? I mean, so there's a reality of an of a addressable market, there's a reality of technological evolution, and there's the other difficult part of assessing how much you should invest as a passive investor in
Mhm.
such a new technology or a new opportunity. And to me, that's all the play money part,
Yeah.
right? Until you seriously understand the metrics,
Yeah.
and then you can put serious capital behind it,
This
even at a
reminds
higher
me.
price.
This reminds me of what Mark Andreessen said recently. I know where I read that.
Mhm.
It was an interview, and he said there are no bad ideas. They're just ahead of their time.
Correct.
So, for example, in 1999 or 2000, Amazon seemed like a terrible idea. It was just too early. So, at
Yeah.
some point, it'll get it right. But how you allocate goes back to
Yeah.
allocation.
That's right.
If you had allocated well,
Yeah.
you'd be fine, right?
Yeah, absolutely.
You'd be
Correct.
fine. So you, if I understand this right, you're saying that yes, you can get swept away in a mania, as long as you don't shake your allocation and feed the mania from the tip of the pyramid.
It's
You
fine.
know, you're
Yeah.
fine. You'll
Put
still
play
have
money.
you can have
Yeah.
still a lot to talk to at cocktail
That's right.
parties and say,
And
hey,
you
I
know,
bought
if
this stock. Yeah.
correct, and if something at the tip of the pyramid becomes real and is
Mhm.
doing well, you
Mhm.
can always put more capital behind because now you have more visibility. Right?
Yeah.
There is no shame if you missed Amazon at $1,
Yeah.
but if at $60 or $80 or $100,
Yeah.
when you have more visibility, if you believe you have it, you put
Yeah.
up, you buy it for $100. There's no shame in that.
Yeah.
You should not say, "Oh, I wish I bought at one." No, at one, it's a concept. You have really no idea what's going to happen. No one has an idea what's going to happen.
Yeah.
But once it's got a visibility, then you can measure it and you're willing to pay more. And that's where the other part, which many young people don't understand, and actually many people don't, young or old, don't understand, is the alternative to your investment, which is the risk-free rate of return.
Mhm.
No
Mhm.
one's understood, or people have forgotten that concept of risk-free rate of return. We've lived in a world, or have grown up in a world for most people, of easy money and cheap money until a few months ago. 70% or whatever the number was of European bonds had negative yields, right? The hundreds of billions of dollars were giving you negative yields, i.e., if I gave the German government 100 euro, they were going to pay me back 99 euro after 3 years or whatever it was,
Mhm.
right?
Mhm.
That was just till a few months ago. All this was going on, stupid stuff. So in that environment, when capital is not, so I want to distinguish, as I was taught, between money and capital. So
Okay.
there's play money at the top of the pyramid, and there's investment capital in the other two blocks of the pyramid, right? And Sam Zell, who's a very seasoned real estate investor
Mhm.
in the UK, he sold his property portfolio, about a decade ago, 2007. And so Sam Zell and I were giving a talk together. He was the keynote speaker one. I was keynote speaker two. So before we got up on the dais, we said hello to each other and exchanged greetings. And he asked me, he said, young man, he's much older than me. He said, young man, what do you do? And, not that I'm young, but relative.
Yeah.
So I said, I manage money. He said, what? So I told him value investing. He said, no. You don't manage money. You manage capital. Capital has a cost related to it. Money is free,
Mhm.
right? So money is what you play with. Capital is what you invest. So now the risk-free rate of return, which is in the global world, is the US 10-year bond. The US 10-year government of USA bond was on average between 4.5% to 5% per annum. And we've been so used to seeing it at 1% and 0.5% and 2% and all for a long, long period of time because of all the printing going on in a post-Lehman world. Now it's moving up to 2.93%, breaking those barriers, and people are nervous. And people are thinking that, where's it going to end? Is it going to end at 4, 5? Where's it going to go? But anything which you're doing as an investment, your first option is, what if I invest in the US government and I get 5% rate of return? Is that good enough for me or not? Or do you have a better rate of return? And this is very important to understand because all the foreign money in the world, owned by the pensions, owned by the university endowments, the foundations, the sovereign funds, that's how they invest. They first look at the risk-free rate of return in their home country or the US bond. So if the US government is offering California teachers pension or California state employee, CalPERS or CalSTRS, who are the $400 billion each behemoth giants in the US pension funds, if they can earn 5% by investing in their home country, right? They'll put a chunk of their money in that 5%, and they'll put a little bit of money in everything else, including US equity, including emerging markets, including Indian stocks. But when interest rates are zero, they're not earning anything in their home country, and they have to earn a rate of 7% to pay off their pension employees and pension teachers. Then they begin to invest around the world and in stocks in India or the world and the US to see how much higher rate of return they can get. So there's going to be that weighing scale. As interest rates go up in the US, there'll be less reason for people to invest in stocks around the world, including India. Okay, so you'll see that. And as we've seen in India the last 4 or 5 months, there's been persistent selling by foreign investors because money is going back to home base, to home country, because interest rates are increasing on that. So a local, a retail, an individual investor must recognize, in their case, what is the State Bank of India FD rate. If the SBI FD rate becomes 11 or 12%, I will just put all my money there.
SBI,
why would I put it in stocks? I'll put a lot less in stocks, and I'll put a lot less in gold. Right? So, a lot depends on interest. Interest rates are absolutely the most fundamental foundation of how you should think about investing.
I remember you telling us, and I'm going to say late 90s, that the first thing you do, and now I do that every day, by the way, is to see the 10-year US yield.
Yeah, I mean, I did not see it for many years because it was fiction. But now I see it again. So to go back, right? So in an environment where there's fiction money, where you've got interest rates which are sub-zero or close to zero for a decade, and in an environment where everyone is using the stock market as a speculation place and not, it's like a place to play tin patti and back horses as opposed to a place to deploy capital. Again, going back to economics and learnings, the reason why you have financial markets is to take the savings of households and put those savings to work in the economy so that companies can invest and create jobs, which creates wealth, which again creates savings. It's like a virtuous cycle.
That's right.
And financial markets are meant to be that bridge. What has happened in the world, that's another episode I get of a podcast, is that financial markets have begun to rule everything else. That's why we talk about Wall Street and Main Street. Right? This dichotomy. The financial markets are supposed to serve Main Street. Now the financial markets are actually making Main Street poor and enriching Wall Street. Completely not what they're supposed to be doing.
Tail wagging the dog situation.
Absolutely. Tail not riding it. It's like swallowing the dog. Very sad.
So tell us one episode where you got caught up for early in your career in one of these market moves, if you will, in a stock or in a commodity, in something.
BITV. I've had many, but I'll tell you BITV because it's one that
BITV would be Business India Television.
India Television. So remember going back to my story about my dentist and everything. So, obviously I'm a big fan and big follower of BITV. And I used to write for BITV also, various articles.
Business India Magazine,
Business India Magazine, sorry, for a long time. So, we invested under Jardine Fleming Quantum. We invested in ZTV when it was a concept. There was nothing about private television in those days. And, and that did extremely well.
That's right.
And then because we did well in ZTV, people came to us with a whole bunch of, media sort of things to look at. So Ashok Advani of BITV approached us in 1994, I'm going to say, and he approached us with a business plan to take the magazine Business India, and he recruited 3 people to run 3 other verticals for him. One was going to be Raghav Bell to run stock markets and financial market vertical. The other was Pranay Roy to run everything about what's going to happen in politics. Everyone in India loves politics, so the political side. And the other was Shekhar Kapoor, who was going to run all the entertainment stuff. And BI itself was going to get a joint venture with BBC of the UK. So what we were presented with was this, wonderful
Dream team.
dream team, absolutely dream team. And, on the phone, as Jardine Fleming Quantum, I helped BITV raise, I'm going to say 70, 80 crores. I can't remember the number, but it was a big amount of
Big
money.
amount those days.
70 in those, big amount of money. And, to help them, because they had to set up a TV channel, they were going to set up a transponder in Nepal, because private TV channels were still not allowed in India. So set up a transponder in Nepal, and Nepal would beam to India, etc. As much as Z had a connection with Rupert Murdoch and Sky for their transponders when we invested with them. So he was going to set up one in Nepal. And it was 1994. And, he was waiting for these approvals, and he got these 60, 70 crores. And I think, I don't quite know the details, but I think that was because he had so much money with him, people started coming to him to borrow money from him. So he became like a mini bank.
Okay.
Right? And while waiting for the approvals. And he gave money to A, to B, to C, to D at all, 2% a month interest, 3% a month interest. Those were the interest rates in those days, 24%, 36% interest, etc., etc. So he had all that done. And then we had the December 1994 tequila crisis. That's when Mexico went bankrupt.
That's right. Yeah.
And the emerging markets collapsed, because when that happens, everyone goes back to home country. Home country in the developed world is Germany, London, Norway, Sweden, whatever, USA, etc. All the money goes back. It doesn't stay in emerging markets. So India got whacked by that too. The rupee currency, stock markets, everything went down. Interest rates went up further, etc. Everything went wrong for India after that 95. So at that point in time, he'd given money out, like I said, unsecured loans or whatever they were. And then he asked for the money back. The money never came back. So then he started getting approvals, and he's got hiring staff and money to be spent, and he had no money. So he started borrowing at 3-4% a month. And of course, the whole thing just imploded. But I'm laughing, but it was very sad, because if you think about it, each of the people that he had went on to do something brilliant. Shekhar Kapoor has won an Academy Award. Pranay Roy has built a fabulous franchise and company in NDTV. Raghav Bell built up TV18, Money Control, which he then sold to the Ambanis or whatever, CNBC. But, each of them were fantastic.
Yeah.
But, we just, we made an investment where we had a bad CFO, I guess, or just bad
discipline. This was within the first 5 years of your entrepreneurial journey. So it must have been quite instructive.
And this was a big mistake. I mean, this was like, not only my capital, but I got clients' funds to invest in them. So big international groups. The good news is that after I left Jardine Fleming, one of those guys who lost money was my first client when I left. So that
they obviously saw something over there.
Well, also because, like I said, as long as you have more winners than losers, people don't mind your losses, as long as you have more winners. So we made, multiple such. I remember Namaste Exports. That was another IPO done at the Trident Hotel at the rooftop. Great looking models walking around and doing that Namaste Exports, leather garments, leather bags, and all that stuff. And done. There was NEPC, NEPC Micon. Anyone remember NEPC Airlines, whatever else? So I remember meeting the senior man at that time, Mr. Kimka. So they just set up the airlines. They can't be like, what are you doing with an airline? I remember sitting in his office and he explained to me the rationale for being in an airline, which was I will invest in anything where I get 1 rupee a kilo as a revenue. So from salt, he had NEPC salt to NEPC Micon, which was windmills, to NEPC airline, which was 1 rupee a kilo. I guess I never did the calculation. We didn't hang around long enough to be in the stock. But you make these mistakes, you make these blunders, you learn. There's a sadness though. Sometimes you make a fantastic call and someone takes it away from you. So Bharti, at one point in time, I think we owned 6 or 7% of Bharti. Bharti Telecom was making push button telephones.
The Beetle phones, the Beetle phones.
The Beetle phones, exactly, which is a big sort of revolutionary thing. And I remember in 1993 or whatever the year was, they got the license to have a mobile phone system with a partnership of an Italian company called STET, S-T-E-T. And I remember going to meet Naren Murthy for their IPO. That was 92 actually. So I remember this happened 92, 93. I remember going through IPO and he was telling us about how it was very expensive. It cost, I think it was 10 lakhs of rupees to get a 28 kbps line from MTNL. Okay, 20 lakh rupees, something stupid, or 10 lakh, stupid like that, for a 28 kbps line. And here we knew that Bharti was getting a license for mobile. So you kind of match the two, figure out that, mobile costs would come down and there'd be more revenues for this. Bharti was snatched away from us. The company delisted. We were the last guys to sell. We had to sell because we're not allowed to own delisted stocks. And then after 2-3 years, Warburg Pincus claimed credit and said, look what we did. Well, we were there before them, but sadly we were crowded out and we lost, hundreds of millions of dollars of profits by not being in it on behalf of clients. So you get these misses too, where you make the right investment, but somehow a regulatory environment or, change of heart of the founder or something takes away the pie from you.
Yeah. So of course, one thing we're going to delve deeper into is the Infosys IPO, 1992, and meeting Mr. Murthy. That's something I think very few people were close to that situation. You were. So we're going to talk more about that.
Perfect. We'll do so. Okay.
We can stop it here.
Yeah.
Thank you. That's the cliffhanger.
That's a cliffhanger for next time.
Thank you, Ajit. Thank you for your time.
Thank you very much. Thanks a lot. Thank you.